Hi, welcome to the new episode of Startup Strides. Today, my guest is Freya Wordsworth. She's a senior investment associate at Ascension VC. Welcome, Freya.
Thanks, Javid. I'm really happy to be here. Thanks for having me on your podcast.
Of course, I'm really excited about this episode. We have a lot of questions to go through, and I've been following your posts, and also your fundamental series, which I have a question about too. So I'm really excited about this episode. But before I guess we start with the questions, it's kind of a tradition now to give every guest a chance to introduce themselves in their own words. So the stage is yours, Freya.
I love that. So to introduce myself, I'm Freya Wordsworth. I'm an investor at Ascension VC. I joined Ascension almost 2 years ago now, and have a background in startups, so kind of across health tech startups as well as a couple of fintech startups. And then had a really weird route into the startup world, originally working in international development. Seemingly there's no link, but I feel like I try to use some of those learnings from a couple of years in a totally different industry in the way that I invest now.
Fair enough. International development makes sense if you consider impact investing too, right? In many ways. Looking at your background, I've seen you've been close to founders in many capacities. The regionally, the founding network, TZ. And why did you decide that your highest leverage was as an investor rather than as a full-time founder yourself?
Yeah, it's a brilliant question, and I would say it's not my biggest leverage. In a way, I'd say it's a weakness of mine. I think being a founder is an incredibly brave thing. You've got to have an interest in doing something super risky. You've got to be prepared to live in a super volatile world. And you've got to have that absolute hunger to build something that's yours and to face the challenges that come with being a founder. And it's one of the most rewarding things, but it's also one of the most difficult and high pressure environments to be an actual founder. I loved working with founders. I love being in the startup world, but being an investor allowed me to sit on the other side of the fence, work with startups, but not need to be in a startup. And the beauty of being an investor as well is every time I do due diligence on a deal, every time I look at a new deal, I almost have a semi day of due diligence into or insight into a whole world that I didn't know before. One day I might be looking at like a health tech startup focusing really closely on, I don't know, fertility, for example. And then the next day I might be looking at virtual power plants within energy. And so it allows you to kind of have snapshots into these amazing creative worlds that startup founders are doing every day.
Do you ever get that itch that you wanna, at some point become? Because there's right now we see a lot of movements between VC and the startup world and startup world VC. Yeah. Do you, being exposed to so many founders and ideas, do you ever get that itch that maybe one day I want to do something of my own?
100%. I think the first year in VC, I was like, oh, phew, finally I'm out of startups. I can relax, I can breathe. But I think the more time you spend with founders and the more you see the founders that you've invested in actually grow and scale, and you see like an early stage company that maybe had 2 people in it suddenly become like a 10-person company or a 20-person company that's actually having a real impact and it's driving real change in the world. That looks amazing and so rewarding. So I think the longer I spend in VC, the longer that itch will be with me, and I'll want to maybe think about being a founder one day in the future.
One day in the future. So you obviously, you've been working as an investor for some time now. If you had to write your own 1-page Freya investment memo, right, about how you make decisions, what would be on it? And I guess what I'm curious about, what do you over-index on compared to most early stage investors?
Yeah, it's a great question. And I think there's a lot of these investment memo blueprints that you can follow. And ultimately, as an investor, you do kind of need to tick off a lot of those questions. So, it's all the standard things like, what is your product? Where are you at with building your product? What's your route to market? What's the competition look like? Et cetera, et cetera. And that's the kind of checkbox exercise that you'll follow when you're really early on in investing. But actually, there is so much more to it. And I think for me personally, as an investor, my style is to be more conversational with the founders. I'm investing at pre-seed, so founders are maybe doing this for the first time. It can sometimes be quite a daunting experience. And I think there's this misunderstanding almost in the market that investors need to be this like scary power play. They hold the money. you've got to like prep loads and then pitch perfectly, and you've got to know every single digit on your financial model because they might grill you on that. And I don't think that's really fair at all, because a lot of investors haven't even been a founder before. And so for me personally, my style is to be chatty, to get to know the founder, to make them feel comfortable so that I can understand what drives them as a founder, to understand if they've got the traits that I believe make a really good founder, and to really understand their motivations behind why they're building this business and why they think this will be a business that will win to a scale that a VC will need it to win.
You touched upon something, so I want to ask a follow-up question. Do you think having a startup experience is necessary for being a good investor?
I don't think it's necessary, but I think it helps. So a lot of investors come into VC not from being the founder. The majority of investors come into VC from like a consultancy background or, banking or whatever. And I think that is super useful, especially in later stage funds. So if you're working for a fund that's like Series A and beyond, it's much more technical, because when you're doing your due diligence, you're looking, there's a lot more to go on. The company's been around for X number of years. They've actually got traction. They've got contracts. They've got revenue. You need to dig into that, and you need to have the kind of financial know-how to do that. But I think if you're an investor at pre-seed, it really helps to have that founder experience or have worked in early stage companies, because the things that go on for a pre-seed seed company, they're very different than what happens later on when the company is like a bit more fully fledged. Bureaucracy's in place, you've got an HR department, you've got a CFO, you've got all these things in place. But I find that having worked with founders before and been in early stage companies, that's really helped me kind of understand what the founders are going through early on, which I think gives me a bit of an edge as an investor.
I feel like later stages, as you said, they become quite technical, and I feel like you can kind of buy into that run if you have the huge brand name and you have a lot of money. I feel like the actual this VC work that happens in the pre-seed seed stages where it's really the idea and the person, right? Like there's nothing else happening. And that's the intersection of the art and science of VC. It's required to have a lot strong taste, good judgment, right? Like it's, especially in the kind of age of hype deals and, hype trends and all that, you have to have some sort of like an independent thinking. And I'm curious, like, what's your approach to that? How do you manage to really navigate that art and science of VC at early stages and manage to stay? Because sometimes I read startup stuff and, all the news and the posts, and I feel like I start to think a certain way just because of how much I'm exposed to certain ways of, So how do you manage to kind of like take a step back and think in your own independent ways?
I mean, there's a few different ways of doing VC in a way. Sometimes you can be like Harry Stebbings and make a decision in like 4 minutes on a deal. But at the same time, it's possibly easier to be like that when you're investing really early on because there's nothing else to go on. But at the same time, if you're a pre-seed investor and you're doing your due diligence, I would actually argue there is still quite a lot to go on. And even if there isn't any revenue yet, even if there haven't been any contracts, I really love going through a model because it allows you to understand the logic of a founder. So if you think about, as an investor, you're building your conviction through various different signals, each making up a segment of a pie. If you can get to 100% of that pie, then you've got your conviction and you'd want to invest. The later stage you go, the more segments of that pie there are. There's more things to go on, there's more things to check. But earlier on, maybe the company's only been around for 1 month and it's all kind of conceptual. There's not even an MVP, in which case almost 100% of that pie has to be made up on the founder track record. But every single startup I look at has an entirely different combination or recipe to that pie. And I don't think I've looked at any deal in the same way. I think every deal is at a different stage, is doing something differently. So I think for me, it's a really unique process for every single deal, to be honest, how I'm doing that due diligence and structuring that due diligence.
So it's very unique to each deal, essentially.
Yeah, 100%. It's so unique. Like there's no deal that has the same combination of priority for each different section of your due diligence. Like for one deal, maybe you don't know anything about the founders, or you do know, but they don't really have that much of a track record. But actually what's super interesting is the technology that they have built, in which case you're focusing way more on that. But yeah, I'd say that recipe is just so different for every single deal. So you kind of got to get comfortable with going off script and going off your checklist and being quite sharp, to be honest, with the signals you get through that first call. When a founder is talking to you, you're kind of reprioritizing at every second where you're getting your conviction from for that deal.
That's really cool. I remember talking to one investor, and she was mentioning about missionary founders and mercenary founders, and essentially what she was describing is that mercenary founders tend to ride the trends and the hype, like AI, clean tech, cryptocurrency, and sometimes they're very successful, but very often you'll not see a lot of success. As there's a missionary founders, it's either some personal reason, or they so experience it firsthand, or they lived through it or something, and they want to just build it regardless of anything, right? And those founders tend to be really successful in it because there's just obsession because of how personal it is. How do you find, like, how do you balance, and how do you find those people? How do you look for those people?
Yeah, 100%. I mean, we love mission-led founders, and mission-led founders are normally the types of founders that have those unique insights into the market because possibly they've experienced something in the past that links to it, or they have a unique kind of work experience which has led them to this. And that is extremely important at pre-seed, because you're kind of understanding why that founder is different from any other founder and why they will be the one that will succeed and become the outlier in this space. So I think, how do we source these founders? In a way, you've just got to build a really good tech stack to make sure that beyond your own network and the traditional way of just being an absolute social butterfly in VC, and that's how you get deal flow. There's so much more now that you've got to do, and that's what you need nowadays to be a good investor. So for us, we, as many funds do nowadays, we scrape for deals, for pre-seed deals and for stealth founders. From that, we also have a psychometric test. So for the first call that we have with founders, we use that psychometric test to kind of gauge or start getting an idea of the traits of those founders. And this all adds together into us starting to understand what type of a founder it is, how absolutely obsessed they are with the problem, why they are so obsessed with the problem, which really helps us to know like how far they're going to go to lead this company. I think it's interesting because you really see like two types of founders. You see the founders that want to see it to the end. Their goal is to solve the problem. And then you see the founders that are motivated by being a founder and by building a really cool company and making loads of money, which can actually get you quite far as well, obviously. But at the same time, the risk there is that they will see dollar signs on an exit opportunity, possibly too early on. And so you kind of want to be cautious with those founders sometimes, because you want them to lead it until they get to an exit that is, the VC sized exit that you want, that hopefully returns your fund. You don't want to invest in a founder that just wants to take the first opportunity to exit their company and make, a couple of million, which is amazing, but not quite what the VC needs.
Fair enough. You mentioned psychometric tests, and one thing I've been seeing lately more and more is that there is a lot of automation happening. I mean, AI is automating everything, and I feel like it's coming to some VC stuff, to VC aspects, with looking through decks, analyzing founders, etc. Where do you refuse to automate, and which parts of the investment process do you think should remain stubbornly human?
So the first thing I'm going to say, I wonder if I'm going to backtrack on this soon, but I've seen a lot of tools that are trying to make a VC analyst avatar. And I think it's a really cool concept. And I'm probably going to eat my words in a year's time when every fund is doing this and it just becomes the norm. And I'm going to sound like an old person that doesn't want to change with the tech of the times. But for now, I kind of think it's unfair on founders, because founders, you're building an amazing business. You're working really hard to do that. You're trying to pitch your business and build a relationship with an investor. And so the least we can do is, even if we've used an AI to kind of score it and review it and automatically reject you before you've even met us, if you got through to the point of meeting us, the least we could do is humanly meet you and actually be there and do that first call, not as an avatar, and give you that opportunity to have a relationship with us. So that is the first instance that I would say I'd rather not have an AI do it. I'd rather me do it, or an analyst do that. The second part as well is, during that kind of due diligence process, obviously you're going to want to meet that founder in person at some point, just to build that relationship further, do that vibe check. You're both checking how the relationship feels. And I think that's important, not just for us, but also for the founders, because the founders need to get an understanding of whether this is a relationship that they want to have, whether these are investors that they want to have on their cap table. And I don't think it's really fair to replace the entire investment process with like technology that replaces the need for having like an in-person encounter. I think the relationship and the vibes that you can get from an in-person chat or just a coffee or a drink or whatever, it's so crucial for understanding whether it's meant to be a right investment for you or not.
Such a fair point. Do you think VC analyst roles, there's a lot of automation of junior roles happening these days. Do you think VC analyst role will become obsolete like in coming years, or?
I know. I think as with all of these things, I think it will just change what they do on the day to day. So I think before, analysts would spend all their time outreaching and then managing that pipeline from outreaching and doing those first calls. Now you can automate most of that outreach. So analysts will probably spend more time on first calls. And I think it's just going to feed this wheel along so that more founders are being able to talk to more analysts. But also remember, now the barriers to entry are so much lower for founders. So I think there's probably already, if not there will be soon, way more founders in the market that are seeing the opportunity to build. Previously, having technical understanding of how to build an app or whatever it is would be the barrier to entry, but now you can kind of vibe code your MVP. I think there's going to be a lot more founders that are seeing that opportunity and building in this space. So I think it's just going to kind of feed that wheel along, and analysts will have more of those first tools.
Fair enough. Speaking of VC analysts, I've mentioned your fundamentals, which you co-host, a learning series for junior VCs. And I'm curious, you've been in the space for a while and you teach fundamentals too. So what are the most common mistakes you see juniors, scouts or VC analysts make when they first start picking companies?
Yeah, of course. Well, I'll just, so if people listening don't know fundamentals, so I co-host an event series with my friend Anna from Nauta, and we both came into VC from totally different backgrounds. And if you come from VC without that financial background, then you kind of need to teach yourself how to read a financial model, how to, look at a cap table. But then if you come from VC from, a consulting background, for example, then maybe you've got to teach yourself more like day to day, what's it like being a founder. So Anna and I decided to run this fundamentals event series that does like a deep dive each session on something super technical within VC that basically we'd never learned and we had to teach ourselves. And the feedback's been great because a lot of junior VCs were struggling to not have that feeling of being out of our depth with some of the due diligence that we're doing. You just kind of have to learn it as you go. And it's the best way to learn, but at the same time, you do sometimes feel a bit uncomfortable. You're looking at a really, really hard financial model for a company that has like multiple different revenues. And all of a sudden you're like, God, am I the right person to be reviewing this? So yeah, so far we've had that area that a lot of junior struggle with. And I'd say this is probably within the first like 2 months of being an investor, is looking at deals and assessing the market for it based on how much you think you connect to it or how much you would use it. And I think early on in VC, if you haven't had experience in investing before, it's super easy to love all of the consumer deals.
Mm-hmm.
Of all the deals that have an amazing brand and a pretty deck. But that is not the right way forward. I've really had to train myself out of loving a pretty deck because sometimes the best have the clunkiest, horrible deck.
Or no deck at all.
Yeah, exactly. So, no deck at all, it's not enough of an indication on whether it's a good deal or not. So you kind of got to train yourself out of that frame of mind of thinking, oh yeah, I would love to use this. This is amazing. And actually looking deeper into it and being like, is the market there? Are the contract values even big enough? Like I would use it because it doesn't cost me anything, and I would use it every day, but it costs me like next to nothing. But that is not a VC backable business because there's no revenue there.
Yeah, fair enough. Actually, I have another question, but I want to ask this very quickly. One thing I'm noticing is obviously the VC landscape is changing, and I have a few questions around that. But I want to ask this something I'm curious about myself, the startups, OpenAI, Anthropic, and etc. They are not some established incumbents, right? They're not some corporate companies, like large corporate companies, this bureaucratic regime. No, they're just large startups. So they're actively working, actively producing new things. And I feel like a lot of the consumer startups we are seeing right now, especially consumer AI startups, will probably be replaced by a lot of the new updates within those models, right? Even in things like finance and healthcare, you see them expanding into those sectors too. So, and what's going to happen to fund? Where is it going to build? What is it going to build? The stuff like the seed rounds are also changing. You see this millions in seed rounds. You see like huge numbers, which before I mean, the seed round would be like max what, like 500K, 1 million, right? So what's going to happen to just the pre-seed rounds? Where these people founders going to build? What's going to happen? Do you have any kind of thoughts and predictions about the future of where this is going?
For sure. I think it's on a lot of investors' minds. So a year ago, we would be super excited. No, maybe I'll be a bit more friendly to us. A year and a half ago, we'd be super excited about anything that had just slapped AI on the pitch deck. But I think investors are really kind of cottoning on to the fact that that's not really what should excite us anymore. And actually, because these barriers to entry, as I was mentioning earlier, are so low, it's kind of a reason why these deals are now not that defensible, and we worry that they will get gobbled up by these companies, like OpenAI, that have already made king in the industry, and it might just be on their roadmap for a year's time. And I think it is a massive concern because there are a lot of companies that have been well funded. They've got to like Series A, B. They solve a problem within this market, but they will easily be kind of gobbled up by these major players. So I think with that in mind, a lot of investors are starting to try and think about how we can protect ourselves and invest into things that have more defensibility. And so what that means is rethinking what defensibility means as well for us. So one thing that we've been talking about a lot at Ascension has been looking at companies that are trying to build vertically, so own an entire kind of stack. So previously, you'd maybe see something that had an in-person element as not scalable or more capital inefficient. But now, if there is a company that has elements of AI, but they are owning an entire vertical stack and they are solving the entire problem, they are no longer like a point solution. So because of that, they solve the entire problem. Maybe it's better if I give an example for this. So in healthcare, a few years ago, there were a lot of amazing companies that came into the market. There were point solutions and they solved like an element of a problem. But nowadays, that's too easy to build and it's not that defensible anymore. So we look a lot more at health companies that are building vertically along a problem area. So for example, a recent investment that we made into a company called Health is solving the provision of care for women that have just had a baby, so postnatal women. And instead of just being a point solution and doing like diagnosis of a condition that they're going through, they actually do everything from, the blood tests that you have to have after having a baby, to the treatment, to connecting you to the right doctors. So they're building like the whole entire stack, enabling them to own the entire area. So I think for us, like that is the sort of thing that is becoming more interesting in this new market, where it's like the intersection between AI and owning the solution to something, but also maybe looking at areas like higher regulated industries or companies that rely on a massive data moat, because those are things that now give you that defensibility that actually you're kind of struggling with just like a normal kind of AI super scalable company that is now more easier to build.
Oh, that's really interesting points. And I think I saw somebody mention something similar about the health tech stuff, but also I saw another post where they were like, if you go after too many things at the same time, you might like run out of the cash and you might, kind of not really find your market, product market fit. How do you balance between, having a good enough kind of a point solution, which might be quite successful, and also not like, I guess spreading yourself too thin, things at the same time?
I see what you mean. So like, how do you not, like, if you want to build vertically, then maybe you're biting off more than you can chew because you need to excel in like every single area and do that. And I think it's a careful balance between building what you can build, but then also maybe wrapping up other solutions within your stack. So, for example, in this health tech example, maybe using a third party to cover your blood tests, for example, or like the in-person visits that you've got to do, and doing that in the short term. Yes, that means your margins will be they won't be as good because you're having to pay a third party. But what you can do is find the suppliers in the market that can help you to own that entire stack, build that stack, start grabbing market share, becoming the kind of go-to solution. And then once that wheel has gotten going and you're getting that revenue in, then start applying that to building each layer of this stack yourself. And then bit by bit, you will then improve your margins. And then you'll become the go-to provider, but then you'll also over time improve those margins to a point that it becomes sustainable for you as a business.
So are you saying capturing as much market share as possible in the AI age is kind of one of the necessary steps you have to take as a startup?
Yeah, kind of. Or just like, I think that route to market piece is actually so important now. So if you are, I've seen a lot of founders that are actually super aware of how indefensible their technology is. And so they're kind of hyper focused on that route to market. And their focus is we need to win as much market share as possible and make our name, our brand, the go-to for this solution. And then we can double down on making sure that our tech is super robust. I don't think anyone quite knows yet where we're going to land with working out what makes the outlier business in this space yet. But in my view, I think that is the focus. I think defensibility wise of your technology, I think that's harder now. I think that's really hard to do unless you have like a regulatory moat or that data moat. So I think instead you're kind of having to see that route to market side as your defensibility, and like how can you be the first to grab that market share, and that will become your defensibility.
Fair enough. So I guess I want to bring the conversation more to the fund you're working at, Ascension. You guys, there's huge focus on investing with purpose and solving societal challenges. And I'm curious, day to day, how does that actually show up in your investment committee decisions and term sheets?
Yeah, for sure. And I think for us, it's always been really crucial that we're not like a box ticking fund that says that we're an impact fund, but ultimately when it comes down to it, it just kind of goes out the window. So we actually take it really seriously, and in our view, having impact KPIs or having an impact or mission driven brand for a lot of the startups, we've seen how it's allowed the startups to win more business, win more customers. WageStream is a fantastic example of that. So that's one of our portfolio companies from our Fair by Design fund. WageStream have used their kind of impact brand as a way to win with massive customers like NHS trusts. So it's kind of only propelled their potential revenue wise. So we kind of bake in impact and tracking these KPIs right from the get-go. So when I'm looking at startups and looking at pre-seed deals, quite a lot of the time founders don't really realize that they're an impact business, but we'll kind of walk them through that, explain how we can track it in a way that doesn't take all their time from them. We don't want to be those annoying investors that suddenly come in and say, oh, you've got to report on these million data points. And then the founders end up spending their entire time doing reporting rather than building the business. But we'll actually set out a lot of those KPIs in the term sheet. So we'll do it from that early point, and then we'll start tracking it early on. But we're quite flexible with it. So early on, founders might not have any data to report on, or they might need to come back to us and say, look, this KPI isn't working, like we can't really record it, it's really tricky for us to record. In which case we go back and forth until we find a set of KPIs that actually represents what they're doing. What we also do is try to build out a calculation that can be taken from their KPIs. So for example, let's say a company is in the energy space and it is decarbonizing homes, then we would take an assumption based on like research online on the decrease in household energy bills, for example, from decarbonizing a home. And then we might be able to track a known KPI from that deal of how many homes they've managed to decarbonize. And we can build that into a calculation that helps us understand the overall costs for, or the overall cost reduction for the households that they've worked with on those household energy bills. So that would be an example of like an impact KPI that then that founder can use to build an impact brand and sell to customers that might be more motivated for that.
Fair enough. Before, and correct me if I'm wrong, I feel like there was a bit of a negative connotation around impact investing in terms of like, oh, if it's impact investing, that in making a lot of profit, that didn't really kind of go hand in hand before.
Yeah.
Actually, there was kind of like that level of understanding. But I feel like there's a bit of a shift in that. Do you think there's a shift in that aspect?
I think there is a shift, but I think it's happening too slow. I think even we still struggle with being an impact fund because too often we're talking to people in the industry and they have that same assumption that because we're an impact fund, we focus only on the impact. We only care about the impact KPIs. We don't really care if they make any revenue. And it's just not the case. We're first and foremost a VC fund. We have the same fund model as other VCs, but we also track those impact KPIs. And I think the misunderstanding comes down to whether the impact is baked into the actual business model of a company. So we wouldn't invest into an impact business unless the very nature of what the business model is causes that impact. So it has to be kind of inherent into business, because then what that will mean is the more the business grows, the more revenue they make, the more impact they will have. But baked in that the scalability of the revenue must equal the scalability of that impact. And in our view, need for that impact is almost, it shows demand in the market for that. So in a way, it shows the kind of possibly the blue ocean market opportunity for that proposition.
When you come across this, early stage deals, pre-seed, seed, when, I guess there's often no data whatsoever. What does good impact measurement look like? And are there any impact metrics you think actually kind of harmful and misleading?
Yeah. I mean, I'll answer the second part of that question first, because I personally struggle with ESG metrics and data collection for pre-seed businesses, because I think ESG, by nature of what it is, it's too kind of tick boxy when you're a pre-seed business, and I don't think it necessarily reflects exactly what that business is doing. So I think ESG is super important, especially for later stage companies, for accountability. But I think you can start to bake that into KPI tracking later on. And I think earlier on, you've got to be much more, you've got to have more tailored KPIs that actually fit that company, that aren't portfolio wide. So I think the best thing that impact investors can do, or founders can do, is to find the KPIs that are specific to their company, rather than like trying to map a load of KPIs that are portfolio wide, because they will become like box ticking, greenwashing sorts of KPIs.
And so I guess what kind of things do you look for when you first come across a startup you don't have much data on? What kind of impact measurements you like to see or hear about from the founders?
Yeah, I mean, it will be totally different on the company. So yeah, I think the main takeaway I would say is it's no specific KPI. It will be hopefully the company is doing something that no other company is doing, or if other companies are doing it, hopefully the market is big enough that there can be multiple players in that market. But because of that, the KPI must be unique to that company. So I don't know, thinking about our portfolio, we've made 8 investments so far from this fund, and no investment has the same set of KPIs as the other investment is specific to what that company is doing. So I don't know, to give an example, we invested in a company called Sprive that helps you to pay off your mortgage quicker. So for that company, it's specifically number of users plus the average reduction in time spent to pay off your mortgage. And from that, we can calculate the amount that you save from your overall mortgage repayments, which gives us the kind of overall company KPI of money saved for households having to pay off their mortgage.
Very
and
cool.
Obviously for that company.
Very cool. Speaking of portfolio, I'm going to ask, are there any, I mean, I'm sure you're excited about every company in your portfolio, but a couple of them maybe you can mention, and maybe are there new areas you're looking into and you're looking to see more startups that are building in that space?
Yeah, it's a really good question. I think this goes back to what I was saying earlier about where we're finding defensibility nowadays. And I think for me, we're looking more closely at those health tech businesses that are more regulated, or they're going towards regulation. And I think if I rewound 6 months ago, I would freak out about any health tech company that would need that regulation, because that's obviously a massive risk, having to work towards regulatory or to go through those hurdles. It can be costly, it's risky, maybe your runway runs out before you manage to get through that. But now I'm quite interested in it because I think it offers these companies that kind of regulatory moat. So for me, it's like it's working out how I can get in front of pre-seed companies and startups they have a clear enough path to how they get regulated, or maybe they have a dual route to market where one path they'll need regulation and that unlocks a massive, amazing revenue stream. But they have a second route to market that maybe sells through hospitals where it doesn't need the same form of regulation, which allows them to make revenue earlier on. And that is a super smart way of like getting revenue up front, but also still getting your regulatory moat, and then building out that robust defensibility because of that regulation. And I'm finding that really interesting because it's definitely an area that we would have shied away from previously, but now we're looking at much more closely.
Freya, I have a question, and it might be a bit of a stupid question, so sorry about that. But one thing I feel like with regulated sectors like healthcare, right? Like because of the regulations, and they tend to be kind of resistant to change and new technologies. And you're looking at scribe technologies when they initially came out. The ones that came out kind of first were the market winners in a way because of like how fast they can capture it, and the newcomers couldn't really compete. So in a space where it's resistant to change and there's a lot of regulations, if you are not the first comer, how do you compete?
Yeah. So in a way, like because these regulated sectors are kind of resistant to change, how do you like overcome that and still sell into that market?
Kind of, yeah, yeah, yeah.
Yeah, I mean, I think it's a challenge. I know I'm talking a lot about the health space, but I think it is a specific challenge, especially within the health space, because a lot of the customers that you're selling to are like resistant to change, resistant to looking at like scrappy startups that have really cool solutions, but a massive NHS trust might be freaked out about the idea of working with a startup that might go under after like a few months. And I think it's challenging. And I think in a way, it allows me as an investor to get quite nitty gritty with founders, because there's a lot of meat for those founders to need to get through. There's a lot that they need to think about to show me that they've considered all of these risks. It does mean that when a founder has considered all of this and they've helped me build my conviction that they've thought it all through and they've got an amazing path, I get the most excited about those types of founders because they've kind of overcome a really tricky challenge. There's a few different ways that founders can do it. So dependent on what they're building, possibly they think about different geographies where the regulatory landscape is different and they initially go out to market there before going back to the initial geography that they were interested in. Or as mentioned earlier, they maybe have like a dual route to market where they'll go through. So I see a lot of like med tech devices that want to become consumer at some point, but that requires like a massive level of regulation. But in the short term, what they can do is sell to pharmacies, for example, where it will be administered by a clinician. So that allows them to reduce the kind of regulatory hurdles that they need to get to before they can go out to market. So kind of clever ways of augmenting their routes to market. I think that makes them interesting. And then whoever gets first to market, it's obviously, I think whoever gets first to market, I think that applies to anything that you're building. It's always a case of, either who gets to market first or whether the market is big enough for a few players.
Fair. One quick question. One thing I've noticed from some posts, I think it was a doctor or investor, I'm not sure, is that there's a lot of focus on new shiny technology, but not enough focus on integration into the healthcare systems, into these large, hospitals and stuff. What can health tech founders think a bit differently when they're coming up with a solution, in your opinion?
Yeah, I mean, I would say it's not on the health tech founders to rethink this. I'd say it's for hospitals, and if we're looking at the UK market, it's for the NHS to rethink the way that they are open to these new innovations. Because as an investor, I see a ton of innovations and solutions to these massive problems that we have in our healthcare system, but the supply of solutions is not the problem. It's the ability for or the willingness of these big beasts to actually give these a go and give them a chance. The NHS has some test beds for startups. I just don't think they're giving enough opportunity for these startups to be able to see if they solve the solution. So I would flip that and say actually it needs to be more on the kind of the big customers, the beast customers, to make it easier for startups, reduce the sales cycles, reduce the that like tendering process, like make that much more easy so that you don't kill a startup with that sales cycle before you even want a contract.
That's such an interesting point. And I guess that kind of ties nice segue to my next question about, you've looked into so many investments, not just your own, investments, your own fund, but also like in your network. What's one structural advantage and one structural weakness of building a startup in UK in 2025?
Yeah, it's a great question. And I think obviously there's been so much talk about like UK, Europe versus the US. But I think there's some great reasons why you should build in the UK. Like London particularly is still a place where great talent is attracted. Like there's some really cool companies in London, and the UK as a whole. So I wouldn't like play that down. And I think we have a great relationship with, with the US, with Silicon Valley. Like I think there's still like a great flow of ideas, talent, etc. between the two. So I feel like there isn't actually that massive divide that everyone tries to say that there is. I also think, with the recent budget announcement this week, obviously some things that are all just a bit ridiculous to hear from that, but some things are actually kind of good in the startup world. So tax efficient schemes, they've made that a little bit they've made that a bit stronger. So I think pre-seed businesses can benefit from that more, which I think is a great way to encourage startups and help them get funded. I think the thing that we need to do a bit better is when it comes to immigration. Obviously, the US is literally drawing a line and, making it much harder for amazing talent to go into the US. And I just don't get why we're not responding to that and opening up our gates more and allowing that talent to come to the UK. Like we seemingly going the opposite way. And I just feel like that is the wrong time. Like this should be the exact time that we open up our gates more and allow that talent to build in the UK.
That's very fair. I guess I want to ties that to kind of a fundraising that's happening these days. What do you think founders are getting wrong about this fundraising cycle, right? Like if a pre-seed founder came to you today, what would you tell them to adjust compared to before?
Yeah. So you mentioned this before, and I realized I didn't even answer your question, but talking about like the pre-seed rounds and the seed rounds that are like 10 million or, crazy valuations, but they still get funded. You kind of hear in the news about all of those crazy big rounds that do get funded because they only get into the news because they successfully raise that capital at that crazy high valuation for a pre-seed business. But from an investor perspective, I see all those deals that are trying to raise capital with really high valuations, massive pre-seed rounds, and they actually don't get funded. So there are a lot of these deals that are seeing that in the market and thinking, hey, we should do the same. And I see it a lot in second-time founders. So founders that have successfully exited, they rightly so have shown that they can be a successful founder and they think that they can do it again, and they are the sorts of founders that are more likely to do so. So kind of fair enough for them thinking that and trying to raise a really big round. But at the same time, I feel like founders should be even more clever and think about the runway they need. If they're going out to raise a pre-seed round, what is that runway they comfortably need to build for a year and then budget 6 months after that year to raise your seed round, or skip seed and go straight to Series A if you think you can get to those metrics quickly. And then start fundraising from investors with a bit more of a conservative round. And then if you're getting that interest from investors, then by all means increase that round size and start generating that hype. But you don't want to be in that awkward position where you said that you've gone out to raise a 10 million pre-seed and then no one funds you, and then you have to go back to the same investors suddenly saying you're raising a 1.5 million pre-seed, because it kind of looks a little bit awkward. So I think that's the one thing that founders are getting wrong. I can see why they're doing it, and I think it probably works in some founders' favors, but I think the damage to your messaging if you've got that wrong can be quite
So you're saying essentially you can still be quite successful even if you don't raise a huge pre-seed round, right? Like if you raise 1K, 1 million, you can still go ahead and do quite a bit.
Yeah, 100%. You just got to work out what runway you need, because for these founders that are raising like a 10 million pre-seed, for sure they can use that to scale quickly, but at the same time, from an investor perspective, you want to make sure that they're not going to like bloat their team, lose their super lean, hungry founding team that wants to build like all the time. If they've almost got too much capital, then maybe they jump those hoops and lose that sense of like hungriness too early on. So I think founders can work out that runway that they need. Like, that's the fundamental thing that should structure how much you are raising. You are raising that capital to give you that runway to build, to get to those metrics for that next round. It's not just like, finger in the air, like I want a million. So I think, do that, work out conservatively, assuming you're not going to get any revenue, assuming things go wrong, like how much runway you need for that 18 months period, and then test investor responses. And if investors are like hyped about you and you've managed to create that hype and FOMO from investors, then by all means increase it, because you're clearly getting the right responses from investors, and raise more because investors are giving you the signal that you can.
I mean, I'm learning so much from you. You're giving some wonderful insights, and I'm curious. I guess it's the nature of your work, right? Like you don't just look into investments; you also give advice to founders and etc. So I'm curious. When you support your portfolio, and the company is going through some rough times, in your opinion, what's a good investor behavior looks like?
Yeah. I mean, so remembering what I said earlier about how I want to be an investor personally, and when I'm doing those first calls with founders, I'm trying to be friendly and putting founders at ease and making sure that they don't fall to that assumption that there's this crazy power dynamic between investors and founders. I think I apply that same thought process to working with founders when things are not going right. So I think it's very easy to feel like, I'm a big investor, I'm gonna sit in the board meeting and grill them in front of the other investors on their cap table, but that's not going to get you anywhere. Like ultimately investors are on the same side as founders. Like we want you to win, because the more you grow, the more our portfolio grows. So we have the same interests. So in the same way that like, if your friend is acting up and you needed to call them out on it and work out a way to change their view, you're not going to call them out on it and grill them in front of your whole friendship group. That's not going to get you anywhere. It's going to cause conflict. You're probably going to fall out with your friend, and they're probably going to go deeper into their hole of behaving badly. So the same kind of applies with founders. Like if you can see that something's not going right and you know that you need to speak to the founder, then ring them up, ask them what's going on, see how you can help, see what they're thinking about it. And then even just like warn them that you might bring that up on the next board meeting. So say, look, I can see that your runway is dwindling. Like I wanted to chat about it now with you to see like if you're also aware of this. Just FYI, I wanted to bring it up on the board meeting. Maybe you want to have a couple of days to prepare for me to ask that question, so that you've got a well thought out question, so you don't feel like put on the spot, because that's only going to help the founder. It's only going to make sure that the conversation is actually productive during that board meeting.
Oh, wow. That's a really nice perspective. I have 10 more questions probably, but I'm going to keep it very brief because I know we're coming towards the end of our episode. So I'm going to ask you a few more questions, and it's going to be more for the founders that might be watching, or the people who want to build. There's a lot of startups out there. New ones are getting built every day, being found every day. Ones do you think, not which one specifically, but I guess what's the most overhyped trend right now that you're seeing? And what's something that looks, from outside quite boring, but is actually very massive and underappreciated opportunity?
Yeah. So something that I see so much of at the moment, and I don't want to sound like, I don't want to say something that's like cancelable, but basically there's a lot of tech that they're trying to find a niche in the market. And so what they do is they build a product and then say that it's for people that have ADHD. And I think that's great. I'm really glad that people are trying to find solutions with ADHD, but I don't feel like it's a way to segment your market and show that you have a unique proposition for a unique segment of the market. So I think that's something that I think is super overhyped. Like, I just see so many deals, so many companies that are specific with people for ADHD. But yeah, just to clarify, I'm really glad people are thinking about people. I just think it's not enough of like a differentiator for how you've thought about your market. So that's something that I think is quite overhyped. And then, I mean, I think the things that are like overlooked, this just goes back to what I was saying earlier, but the kind of more clunkier, boring things that possibly have an element of, you know, something that we might have seen as being more capital intensive in the past, but actually creates an element of defensibility nowadays. Those are the things that I'm finding quite interesting, and they're generally overlooked by VCs because they don't fit this pattern of being super scalable, plug and play. But I think they're the things that VCs are more often looking at nowadays.
Fair. And you touched upon it briefly, you know, before seeing anything with AI was super exciting and you would want to invest. Now, when you look at companies, especially impact-driven companies, where do you think AI is genuinely can be transformative?
Yeah. I mean, I think AI can be transformative in so many different ways, but I think it depends on what you're building, but every company seems to have AI within what they're doing. So where I think it truly makes a difference is if it enables you as a company to, I'm trying to think, if it enables you to like really solve that problem, if it really enables you to build that full stack that, yeah, again, solves that entire problem within like a value chain. So if you're kind of using it to like augment what you're building anyway, then I think that's really interesting, and that's where AI can have a massive impact. But I would say like things like co-pilots or, you know, just wrappers, I think they've been there and they've had their day, and I think investors now are definitely like sick and tired of hearing of those co-pilots nowadays.
Fair enough. Freya, I'm going to ask you my final question, and it's more, you know, towards the founders. And I feel like being an entrepreneur and being a startup founder is very glorified, and rightfully so. It can be quite exciting, and especially for young people. But I guess I want to hear from you now. What's the tough truth you often tell the first-time founders that they don't really want to hear?
Is VC capital really for you? So that is the thing that I struggle to say to founders because it kind of crushes a lot of founders' dreams. But VC capital is not for every founder because we have a fund model. We need you to reach certain revenues within a certain time period. And that doesn't always fit what a founder, what their vision is or what the potential is for that business. So, you know, if your mate said to you at the pub tonight, "Oh my God, I've sold my business for 5 million," you would not stop talking about that for the rest of the night. Like, that is insane. That is the most incredible thing. But that is not a VC-sized business. So I think talking to founders that maybe have just become a founder, you know, they love the idea of like getting VC capital. I think the thing that I sometimes say that is maybe disappointing to founders is, yeah, maybe VC capital isn't the right source of capital for you.
Oh, wow. Very, very honest and very candid perspective. Thank you so much, Freya. This was a lovely episode. I learned a lot from you myself, and I appreciate your time and insights.
Yeah, of course. Happy to join. Thanks for having me on.